Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Helen Mason, Portfolio Manager at Schroders. She's going to be talking to us today about the Schroders Australian High Yielding Credit Fund and how it's being positioned to take advantage of current market dynamics. Hi Helen, thanks for joining us.
Thank you.
So for people who don't know about the fund, can you talk to us about it and what kind of assets it typically invests in?
Sure. So Australian credit is probably, in my view, one of the best asset classes in Australia today. Typically, we invest across the capital stack. So what that means is we invest in corporate credit, so companies that you and I would know. So, for example, Sydney Airport would be one of them, Port of Melbourne would be another, Woolworths would be another. We can buy their senior secured bonds all the way through to subordinated or junior subordinated bonds. So what that means is that we still, in the event of a default, we rank above equity. So essentially you're taking less risk than equity, but you're still getting very compelling yields. So the assets that we invest in the fund, we're very diversified across sector. So we have some financials in there. So we have some banks that you and I would know, CBOE, Westpac, the local banks, but we also have some offshore banks as well. So we're investing in what we call our Australian credit universe, which is effectively companies that are Australian companies and they're issuing into the Australian debt capital markets, but both in Australian dollars and in other currencies. But we also invest in what's known as Kanga issuers. And what Kanga issuers are offshore companies investing into the Australian credit market in Australian dollars. So the fund itself is fully hedged back to Australian dollars. You're not taking any currency risk, but we're getting that broader opportunity set. And today, the available opportunity set is around 340 billion.
So the fund aims to return 2.5% to 3%
Yes.
Per year above the RBA's cash rate
That's
and
right.
before fees. So how does the rate cycle affect your investment opportunity set?
If you think about how the yield is built up and you have effectively the cash rate, and that rises and falls with economic cycles, but then on top of that cash rate, you then have the credit spread or the credit risk premium. So for higher quality companies, that risk premium is smaller than for more risky companies, which would be companies that are potentially rated BBB or below BBB minus, which is called sub-investment grade. So essentially, that risk premium changes over time, but essentially, even if the cash rate falls, you're still attracting that credit risk premium on top of the cash rate. And so that's how we're able to achieve returns through the cycle.
Okay, so what kind of investor would this fund typically suit?
The fund itself is delivering 6% at the moment distributions on a monthly basis. So investors who are looking for income. So you can think about it as an alternative to cash or your term deposits as we start to see the cash rate decline, which is currently what's happening at the moment, but also investors who are concerned about the volatility that we're experiencing overseas and how that's playing out in the Australian equity markets may want to take a little bit of risk off the table, but still retain their income piece. And so it's also a good opportunity for those investors as well.
Okay, so what about liquidity? If an investor wants to sell their units, how does that work?
Yeah, so we have two formats. So we have the unit trust version, which is the Australian High Yielding Credit Fund. But we also have the listed version, which is known as HIGH, H-I-G-H. And so that's daily, the funds, the unit trust and the ETF version are daily liquid. The way that you would trade the units, you can just phone up your broker. There's no limit on that, and you can daily trade. We've never had any problems with liquidity in the fund. And the fund itself, the unit trust, has been running since 2001. So liquidity is really important to us and how we manage the fund. We don't invest in any private debt or any structured credit because they can present liquidity challenges in markets when they dislocate. So primarily, we're very focused on allowing investors to have access through the ETF, but also liquidity, and so the function to make choices when they want to make those choices.
You say also that the fund can work as an alternative to bank hybrids and they're being phased out. So what does that mean and how does the fund work as an alternative to that?
Well, It's better than bank hybrids because with bank hybrids, you're investing in one security through time. And actually, if you look at the chart we're showing here, you can see that the high yielding credit fund has actually outperformed the CBA pearls over time. The benefit investors are actually getting is diversification from the fund. So we are able to think about how we invest through the cycle when valuations are compelling. So valuations on CBA aren't always very compelling, and so we can switch into other opportunities that do look like better value through time. And we have a robust research process that sits behind those names as well. So if we are looking to buy Santander or Lloyds Bank, we can even call our offshore analysts and say, what's your view? Does this deal look like a good idea? And then we work out whether valuations are compelling.
How do you see the future for the fund? Is it safe from the trade wars and the current economic uncertainty? I think, as you mentioned before, you talk about Australian credit being a sweet spot. If you can talk to us about that.
Yeah, I mean, safe is a tricky word, right? I think it's, you definitely, if you're invested in equities at the moment, you would have experienced a lot of volatility. One of the things about Australian credit is it does have lower volatility than the equity market, but you're still getting very strong valuations in the space as well. Is it safe? I think, at the end of the day, we can experience drawdowns in the fund, but what we can do at the same time is present tactical overlays into the fund, which can help protect against some of that volatility that's coming through from equity markets and the challenges in the geopolitical environment offshore. So we've got that, but also because we have a broader team that sit behind us, so we have the fixed income team and the multi-asset team, we're all collaborating on where we see the cycle at any point in time. So we can take risk off the table when we think that we're going into a period that is potentially more volatile. And at the same time, we can run hard into opportunities when we think markets are actually going to be running strong.
Okay, brilliant. Thank you, Helen, for sitting down and sharing your expertise with us today. And,
you're welcome.
Can't wait for our next chat.
Thanks.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel where we release new content every week.